Opinions, going concern. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email, and our phone number. And the source for this information was taken from an SEC form that was filed in 8K and some other referenced articles that we'll see in a Word document here shortly. First of all, let's talk about the company involved. It happens to be a St. Louis-based company where I am, so the story was particularly important in my town. KB Pharmaceutical, and the information was first taken from a June 2010 SEC filing. So first of all, what business are they in? They're a drug manufacturer, and they manufacture a painkiller. And as it happens, their largest client that accounts for about half their business is business from Medicare and Medicaid that is reimbursed to them. Medicare and Medicaid reimbursement. They had a legal issue, a fairly significant one, and it was failure to disclose that they were manufacturing tablets that were oversized. And obviously, if a patient is taking a product that's not the right quantity, it could be potentially harmful to patients. The result was the FDA, the Food and Drug Administration, demanded they stop production and said that they must comply with FDA requirements before they can start producing their product again. So obviously their sales and their profits substantially go away. Audit findings. KPMG, one of the big four, was the auditors, and in the 2009 audit they found material weaknesses in internal controls. Let's define two things. Internal controls have to do with all the processes in your business and keeping, most importantly, segregation of duties. So keeping the recording, the accounting records, the physical assets themselves like cash, equipment, vehicles, and the authority to approve payments, check writing, deposits, keeping those things simple. That is separate. Segregation of duties is a big internal control, and there are others as well that we'll see shortly. A material weakness, I define the word material in this context, and it means it's important enough to change the financial statements, and specifically the impact that the financial statements would have upon the reader. In other words, if you read the first version of the financials, and if you read the financials after the changes because of internal controls, there would be such a big difference that the statement reader might have a different opinion of the company. Audit Committee. The Audit Committee is set up to be a committee within the organization in which the auditors report directly to the board of directors. In other words, they don't report through the company. They report straight to the board, which is supposed to be an independent third party making decisions on behalf of the shareholders. And so what Pete Marek did was they gave the Audit Committee a heads up. They gave them a report that said, look, we found weaknesses in internal controls. We'll see details shortly. And we want to let you know that we found these things, and most importantly, they need to be corrected before the next audit. As soon as possible, but certainly before the next audit. So they come out, and Pete Marek starts to do the 2010 audit. And they warn KB Pharmaceutical that the 2010 audit report will contain a going concern paragraph, which says, in essence, we are concerned that this company does not have the ability to continue in business. And that's going to be in the audit report, and anybody who reads the audited financials is going to look at the report, see that paragraph, and it's going to be a huge red flag. Time goes on even further, and eventually this company has a March 31st year end. So on June 25th, the auditor KPMG resigns. And the reason that they resigned in part is that the company, KB Pharmaceutical, didn't fix the 2009 material weaknesses. We told you had these weaknesses, we told you they'd affect the financial records, and you didn't take steps to correct them. Let's go in a little more detail on Microsoft Word, and if you want to see references for these articles, you'll see the links right here. You see right here the reference to the settlement that they had with the Justice Department. They actually had people plead guilty to criminal counts, two felony counts of criminal fraud for failing to report it was manufacturing oversized tablets that could be harmful to patients, and the company substantially downsizes. Another big red flag is when key people in management resign. And what happened was, this happens to be an article from June, I believe. Yeah, June of 2010. You had the chairman, the CFO, and a board member resign, citing serious concerns about newly elected senior management. Well, what does that mean? Well, the problem was with independence. Again, we want to have a board of directors that operates independently for the most part from the company, that gives objective advice, and that protects the interests of the shareholders who own the company. So in their resignation letters, they said, we have serious concerns regarding the newly constituted board and senior management to provide the independent oversight. They know that only 3 of the board's 7 nominees for board seats were elected at the annual meeting. So the people that are being put up to be on the board aren't getting elected by the shareholders. And further, it turns out that those who were re-elected to the board were the son of the founder and a grandson of the founder and a former employee. So they were concerned, they being the people that resigned, were concerned that the board of directors was not getting independent advice. For a company to meet this requirement, they should focus on having a majority of the board members be independent. They also found that the board was paying themselves a lot of money. The board was paid $116,000 in 2009, a $60,000 raise while the company was involved in massive layoffs. Again, another red flag. Here's the language that was in the announcement when the KPMG resigned as the auditor. It was not recommended or approved by the audit committee. They just felt like they needed to do it. And here is the paragraph that starts to go into what's specifically wrong with the company. As noted in Note 3 of the financial statements, this is the note that we talked about. They've suspended shipment of their product. They've got a consent decree they must comply with. And here's all the negative things that happen as a result. They can't raise capital. They're not manufacturing. They've got uncertainties regarding litigation, getting sued, and they can't meet their debt covenants, meaning that their lenders had covenants or goals they had to meet in terms of debt payments, revenue, etc., that they can't meet anymore. Bottom line in black, raised substantial doubt about the ability to continue as a going concern. Finally, let's talk about these internal control weaknesses, because they go into detail here about what those weaknesses are from the 2009 audit. Entry-level controls. Awareness. Is everybody aware? Are personnel trained? Do they monitor controls? Do they fix them when they're broken? Remediation. In financial statement preparation and review, manual journal entries, all accountants make them. Account reconciliations. If you have an instance where bank accounts in particular are not being reconciled, that's a problem. Customer and supplier agreements, stock-based compensation, Medicare rebates, because again, a large part of the business comes from Medicare and income taxes. How do you apply accounting principles? For example, it's very important in accounting that we maintain the same principles unless we have a good reason to change, and maybe they have violated that. Remember finally that an audit gives an opinion that the financial results are materially correct. That is, that the financial results are not materially misstated. KPMG could not make that claim on the 2010 audit. That's the end of Auditing 8. You'll find hour-long go-to-meeting sessions that we have. Here's our website for one-on-one tutoring and live chat. There's our website also again. Thanks very much, and we'll see you next time.